The stock market has been crashing for the past 3 weeks, and Bitcoin has been bleeding, as well as tech stocks falling. Everyone seems to panic, but then recently it went back up, and we're not sure what's going to happen in the future. But your neighbor, he just made $50,000 last week, so how does this even make sense? Welcome to 2025, where Japan just made a move that has financial analysts around the world paying very close attention. Most people have no idea what's happening, but the smart money saw this shift coming and positioned themselves months ago. Let's break down what's actually going on and why it matters to your portfolio. Reason 1, Japan's interest rates just could have changed the entire game. For 30 years, Japan had one consistent policy: keep interest rates at basically zero and print money to stimulate their economy. They borrowed at near zero rates and invested trillions globally, including $3.3 trillion in US treasuries alone. Japan's 10-year government bond yield just hit 1.7%, the highest level since 2008. Now that might sound small, but here's why it matters. This shift signals the end of what traders call the yen carry trade, one of the most profitable strategies in modern finance. Here's how it worked. Investors borrowed yen at 0% interest, then invested that money in higher yielding assets like US stocks, bonds, real estate, and even crypto. As long as Japan rates stayed near zero, this was essentially free money for leverage. But when Japan's rates go up, the math changes completely. Borrowing costs increase, and suddenly those leverage positions need to be unwound. That means selling assets, which creates downward pressure on markets globally. At 1.7%, Japan's annual interest bill jumps by an extra $27 billion per year on a debt pile that's already 263% of their GDP. They just announced another $110 billion stimulus package because their economy needs support, but the bond market is showing signs of stress. This isn't causing an immediate collapse, but it's adding significant pressure to global markets that have already been dealing with their own challenges. Reason 2, the yen carry trade is unwinding in a negative way. The yen carry trade wasn't just popular with a few hedge funds. It was massive, touching everything from US stocks to European bonds to emerging market debt. When Japan's rates were zero, this trade was a no-brainer. Borrow cheap yen, invest in anything with higher returns, and pocket the difference. Trillions of dollars flowed through this strategy. But now that Japanese rates are rising, the trade is reversing. Investors have to pay more to borrow yen, which means the profit margin shrinks or disappears entirely. So they're closing positions, which means selling assets. This isn't happening overnight, but it's creating volatility. When large institutional investors start unwinding leverage positions, it can create a cascade effect where selling leads to more selling, especially if margin calls get triggered. We're already seeing this play out in currency markets and bond markets. It's one of the several factors putting pressure on US stocks right now, though it's certainly not the only one. Reason number 3 is major buyers of US debt are stepping back. Here's something that doesn't get enough attention in mainstream financial news. Japan has been one of the largest foreign holders of US government debt for decades, and they're starting to sell. China, which is another major holder, has also been reducing its US Treasury holdings. When your two biggest foreign creditors start selling, that creates a supply-demand imbalance. Even though the Federal Reserve cut interest rates recently, long-term bond yields actually went up. That's unusual, and it's partly because these major buyers are stepping back from the market. Higher bond yields mean higher borrowing costs for everyone, from the government to corporations to individuals taking out mortgages. This puts pressure on economic growth, and by extension, corporate profits and stock valuations. It's not just an immediate crisis, but it's also a structural shift that's changing the cost of capital across the economy. Here's reason number 4. The global debt picture is concerning. Let's zoom out because this isn't just about Japan. The US has $38 trillion in debt and it's growing. At current interest rates around 5%, the US could be paying $2.5 trillion per year just in interest payments. That's roughly half of the total government revenue going just to service debt. Japan's debt to GDP ratio is 263%, one of the highest in the developed world. Europe is dealing with its own fiscal challenges. China's growth is slowing and its property sector has serious problems. This doesn't mean everything collapses tomorrow, but it does mean governments have less flexibility to respond to economic downturns. The next recession, whenever it comes, will be harder to fight with traditional tools like interest rate cuts and fiscal stimulus because debt levels are already so high. When economic flexibility decreases, market volatility tends to increase, and that's an environment where both risks and opportunities multiply. Here's reason 5. Retirement security is becoming harder. Here's where this hits regular people. 2/3 of Americans report living paycheck to paycheck, which means retirement savings aren't being built up the way previous generations managed to do. For those who have saved, there's a new fear that's overtaken the traditional fear of death: running out of money before you die. With people living longer thanks to modern medicine, there's a real chance that one spouse in a married couple lives to 100. That means potentially 35 years of retirement without a regular paycheck. The traditional retirement model assumed a 60-40 portfolio of stocks and bonds, with Social Security providing a baseline. But with bond yields having been so suppressed for so long, and stocks at elevated valuations, retirees are facing a challenging environment. When major market shifts happen, like what we're seeing with Japan, it adds uncertainty to retirement planning. This doesn't mean panic is warranted, but it does mean that the old assumptions about safe retirement strategies need to be revisited. Reason number 6, the housing affordability crisis is real. The average age of a first-time homebuyer has been creeping up, and it sits now around 36 years old in many markets, with some data showing that it is even higher. The Housing Affordability Index is at one of its worst levels in decades. Young people are struggling to enter the housing market. High home prices combined with elevated mortgage rates have created a situation where renting often makes more financial sense than buying, even though historically home ownership was a path to building wealth. The government has floated ideas like 50-year mortgages to make monthly payments more affordable, but this dramatically increases the total interest paid over the life of the loan. It's a band-aid solution that doesn't address the underlying supply and affordability issues. Real estate and small business have traditionally been two pillars of the American economy. When both are under stress, it creates economic headwinds that affect everything from construction jobs to business formation rates. Japan's rising rates contribute to this because they affect global capital flows and borrowing costs. But this is primarily a domestic supply and demand issue that has been building for years. Reason number 7, AI is really reshaping the job market. Here's something that sounds like science fiction, but it is really real. Artificial intelligence is starting to automate jobs that we previously thought were safe from automation. Wall Street is excited about AI because it increases productivity and corporate profits. Companies that successfully implement AI can do more with fewer people, which is great for their bottom line and stock price. But from a macroeconomic perspective, there are legitimate concerns about employment disruption. Some estimates suggest 10 to 20% of jobs could be significantly impacted by AI over the next decade. That includes not just manufacturing and data entry, but increasingly white-collar work like accounting, legal research, and even some medical diagnostics. High unemployment at a time when Western economies are already dealing with debt challenges and demographic shifts could create serious economic stress. This isn't an immediate crisis, but it's a trend that's accelerating and worth paying attention to. The irony is that the stock market rallies on AI news because investors see increased profits, while the broader economic implications might not be as positive. So why is your friend getting rich? Your friend didn't get lucky. He or she likely studied market history, paid attention to what central banks were doing, and positioned their portfolio accordingly before the volatility hit. While most retail investors were chasing high-flying tech stocks at all-time highs, most conservative investors were building positions in assets that tend to perform well during periods of currency instability and fiscal stress. Gold, for example, has had a strong run recently. It hit all-time highs, pulled back, then climbed again. Central banks around the world have been buying gold at record levels. India imported $14.5 billion worth of gold in October alone, up 200% from the previous year. This doesn't mean gold is guaranteed to keep rising, but it shows where institutional money and foreign central banks are positioning themselves. Some major financial institutions have started recommending that the traditional 60-40 portfolio of stocks and bonds should shift to something like 60% stocks, 20% bonds, and 20% gold or other alternative assets. That's a significant change from decades of conventional wisdom. So what does this actually mean for you? Let's be clear about what we are saying and what we are not saying. We're not predicting an immediate stock market collapse or saying you should panic sell everything. What we are saying is that Japan's shift away from 0% interest rates represents a structural change in global finance that adds to several other pressures already present in the system. High debt levels, challenging demographics, housing affordability issues, and technological disruption. These factors create an environment of increased volatility and uncertainty. In that environment, traditional investment strategies that worked for the past 40 years might need to be reconsidered. Your friend who made money recently probably did so because they diversified beyond just stocks and bonds. They likely have exposure to commodities, precious metals, real estate, or other assets that can perform well and are not as popular. This doesn't mean abandoning stocks entirely, but it does mean that you have to think more clearly and carefully about your portfolio construction and risk management. It means not assuming that what worked in the past will automatically work in the future. The real lesson here lies in that financial markets are complex systems influenced by countless factors. No single factor determines whether markets go up or down, but paying attention to major structural changes gives you a better chance of positioning your portfolio properly. The investors who thrive during volatile periods aren't the ones with crystal balls who can predict the future, but they are the ones who understand risk, diversify appropriately, and don't assume that recent trends will continue forever. Whether that leads to a crash or just a period of higher volatility remains to be seen. But understanding what's happening gives you the information you need to make informed decisions about your own financial situation. The lion who survives isn't necessarily the strongest or the fastest, but it is the one who sees changes in the environment coming and adapts before the crisis hits. Japan signaled a major environmental change in global finance. So how you respond to that signal is up to you.